housing market is hitting a rough patch these days. Inventory is piling up, prices are slipping, and buyers, well, they're not exactly ready to take the plunge. So is this just a temporary slump or the beginning of a crash?
For sale signs are everywhere. And according to this Zillow map, more than 6,000 homes currently on the market in Cape Coral alone.
One thing after another, we were selling.
2 years ago, Orlando was one of the hottest real estate markets in America. Homes sold within hours. Buyers camped overnight just to make an offer, and local agents called it crash-proof. But now, in 2025, the story has flipped completely. Nearly 1 in 5 home deals in Orlando never make it to closing.
The Orlando housing market correction is now well underway. Home values are going down all across the Orlando housing market, and they will likely continue to drop over the next year. The question is, just how much more are prices going to drop, and is this going to turn into like a full-scale crash like what we saw back in 2008, 2009, or is this just a blip on the radar? These are questions that you need to know the answer to as a home.
Prices are sliding, listings are piling up, and thousands of sellers are slashing asking prices just to survive. Behind the chaos are insurance premiums that can top $7,500 a year and mortgage rates that have doubled since the boom. The result? A city once seen as a real estate safe haven is now facing one of the sharpest housing reversals in the country. For families, it means lost savings and broken dreams. For investors, it's a brutal reminder that no market is immune to fear. So how did the so-called crash-proof capital of Florida go from unstoppable growth to full-blown collapse?
Which is showing that U.S. real estate investors continue to run from this housing market. The investor purchases, they collapsed yet again, especially in Florida. And this data is showing you just how dire the situation is getting in the U.S. housing market. It's really on its last legs right now, because take a look at this data from Redfin, everyone. U.S. investor home purchases fell 6% in the second quarter, the biggest decline since 2023. Now, these investor purchases in the housing market have been declining for the last 3 years. However, they continue to drop. You can see the home purchases by investors dropped by as much as 21% in Fort Lauderdale.
And why do analysts say what's happening in Orlando could spread across the entire country? Let's break down how this happened, step by step. In 2019, Orlando's housing market felt steady and predictable. Exactly what buyers wanted after a decade of national volatility. The median home price sat just under $280,000. Most buyers were locals or retirees chasing sunshine, not investors looking for quick profit. Insurance premiums were reasonable, around $2,000 a year, and homes usually closed within 60 days. There were no frantic bidding wars or panic buying, just a normal, healthy market where families could take their time, negotiate fairly, and still afford to live within city limits. Tourism and job growth kept things balanced, with about 1,000 new residents arriving each week. Orlando was the picture of stability, steady migration, affordable mortgages, and the comforting belief that Florida real estate could weather any storm.
They continue to drop. You can see the home purchases by investors dropped by as much as 21% in Fort Lauderdale. They dropped by 25% in Orlando, and they dropped by 19% in Phoenix. And so these investors continue to not buy homes, and now they're even starting to sell homes. And one has to wonder, what is this investor exodus going to do to home prices over the next couple of years? Because after all, these investors were propping up the housing market for a decade. They were buying all these homes with cheap debt for much of the 2010s, and during the pandemic, they caused the prices to go up. Now they're no longer buying. What's going to happen to prices with these investors no longer buying?
But as we know now, that sense of calm was the setup for one of the most dramatic turnarounds the city had ever seen. Because when the pandemic hit, the rules of real estate changed overnight. When remote work took off, the floodgates opened. People from New York, Chicago, and Boston poured into Central Florida, waving cash and desperate for space. Suddenly, homes that once took months to sell had bidding wars within hours. Buyers skipped inspections, offered $50,000 over asking, and wired deposits before even setting foot in the house. It wasn't just homeowners. Investors and flippers jumped in too, convinced Orlando was the new gold rush. Mortgage rates under 3% fueled the mania. By 2022, the median home price had skyrocketed from $280,000 to $390,000. Builders couldn't keep up, and open houses turned into circus lines stretching down suburban streets. Local radio ads bragged that Orlando was crash-proof, a city where you simply couldn't lose. But under the surface, cracks were already forming. Wages weren't keeping up with the price jumps. Buyers were maxing out their budgets, and what nobody realized yet was that the boom everyone thought would last forever was running on borrowed time. By early 2023, the frenzy had cooled, but few realized the real danger wasn't fading demand. It was insurance. Out of nowhere, homeowners across Central Florida began opening renewal letters that felt like horror stories. A policy that once cost $2,000 a year now jumped to $6,000 or even $10,000. Some families saw their monthly escrow payment double overnight, and they hadn't even missed a bill. For many, it was like a second mortgage, but one they never signed up for. So what happened? Florida's insurance system started cracking under pressure. Years of hurricanes, roof scams, and massive litigation had pushed smaller carriers into bankruptcy. By mid-2023, more than a dozen insurers had either collapsed or left the state entirely. The big names that stayed jacked up their premiums to survive. For homeowners, that meant one of two choices: pay more than ever before or risk losing coverage altogether. For buyers under contract, the chaos was devastating. Imagine spending months hunting for a home, saving every dollar, locking in a loan, only to get an email days before closing saying, "Your insurer pulled out. No coverage available." Without an insurance binder, lenders couldn't finalize the loan. The deal died instantly. Agents reported clients crying in parking lots, watching their dream homes slip away, not because of bad credit, but because no company would take the risk. This wave of failed closings started showing up in data no one wanted to believe. Between late 2023 and mid-2024, nearly 1 in 5 pending contracts in Orlando fell apart because of insurance. In some coastal zip codes, it was even higher, and the buyers who did manage to close found themselves chained to homes they could barely afford. Some took policies with stripped down coverage, no roof protection, no flood insurance, no replacement guarantees, just so they could get approved. Others paid the first year, premium in full, draining savings that had taken years to build. The psychological toll was just as bad. Real estate agents who once made easy commissions were suddenly working twice as hard for half the results. Home inspectors said buyers were skipping coverage checks entirely, hoping to figure it out later. And sellers, desperate to move before their own premiums renewed, started slashing prices. It was panic, quiet panic, but panic all the same. The kind of tension that doesn't make headlines yet, but eats away at confidence from the inside out. And the irony? Most of this had nothing to do with local buyers or sellers. It was the system itself breaking down. Florida's reinsurance costs skyrocketed after a series of billion-dollar storm payouts. Even inland areas like Orlando, far from the coasts, were being priced as high-risk zones. Companies simply couldn't afford to stay. At one point, the state-backed Citizens insurer became the largest in Florida. a last resort safety net that was never designed to carry the entire market. By the end of 2024, homeowners started facing a new nightmare: non-renewal letters. Longtime residents with perfect payment histories were suddenly told their homes were too old or too risky. Some insurers required full roof replacements, even on 10-year-old properties, before offering coverage. For middle-class families already squeezed by inflation, it was impossible. Local Facebook groups filled with desperate posts. Who's your insurer? Can anyone cover a 2005 roof? We might lose the house. These weren't isolated stories. They were warnings that the foundation of Florida's housing boom was cracking in real time. The same city that had sold the dream of endless sunshine now found itself drowning in paperwork, fees, and fear. And that's when it hit the market like a slow-motion crash. Buyers walked away, deals evaporated, and the first price drops began. But just as homeowners thought they'd seen the worst of it, another blow was coming, one that no amount of savings or sunshine could fix: the mortgage rate explosion. If insurance costs were the spark, interest rates were the explosion. In less than 2 years, rates jumped from under 3% to over 7%. That meant a $400,000 home that once required $1,600 a month suddenly demanded nearly $2,700. Families who had stretched to afford homes in 2021 simply couldn't make the numbers work anymore. Mortgage lenders tightened standards, fearful of defaults. First-time buyers, already squeezed by insurance and property taxes, were priced out completely. Builders watched waiting lists evaporate, while sellers grew desperate. Homes that used to sell in days now sat for weeks, and price cuts became routine. Orlando's affordability index plunged to its lowest level in over a decade. And when you combined high premiums with soaring borrowing costs, you got a perfect storm, a market where even qualified buyers started to disappear. But the true collapse didn't happen when prices fell. It happened when deals stopped closing. By early 2025, Orlando's housing market had crossed a line no one thought possible. Internal brokerage data showed nearly 1 in 3 deals collapsing before closing. The highest rate in the country. Lenders refused to cover appraisal gaps as prices fell faster than valuations could keep up. Insurance binders failed to arrive on time. Buyers pulled out days before move-in, unable to afford last-minute premium hikes. One veteran agent said it bluntly: "I've never seen this many walkaways." In some neighborhoods, cancellation rates topped 25%. Families lost deposits of $10,000 or more. Investors backed out mid-contract, warning others to stay away. What had been a booming spring market turned into a pipeline of broken deals and frantic sellers. The housing machine that powered Orlando's economy was suddenly seizing up. And as transactions died, listings began to surge, setting the stage for the next chapter of the collapse. By the middle of 2025, for sale signs lined entire blocks from Lake Nona to Metro West. Active listings were up 80% for condos and 35% for single-family homes. Builders like Lennar and D.R. Horton quietly halted projects, sending crews home and shelving developments that only months earlier had been oversold. A leaked memo from one builder described Orlando as overstocked and under-contracted. Incentives popped up everywhere: rate buydowns, free upgrades, cash at closing, but buyers weren't biting. Condo prices crashed 25% year over year, and association fees doubled to over $800 a month. Appraisers, now surrounded by a sea of declining comps, dragged prices down even further. One builder put it best: "We built for a market that doesn't exist anymore." Every week brought new listings, deeper cuts, and fewer offers. The city that couldn't build homes fast enough now had too many, and no one left to buy them. If you want to see the collapse up close, look at zip code 32789, Winter Park. Once one of the most desirable neighborhoods in Central Florida, it's now the epicenter of the downturn. Over a quarter of all home deals there fail before closing. Average homeowners who bought at the peak have lost $60,000 in paper value. Luxury sellers are dropping prices by $100,000 or more just to get attention. Nearly a third of listings have had multiple price cuts since April, and the typical home now sits on the market for over 2 months. But the numbers only tell half the story. The human side is brutal, like the retired couple who lost their $15,000 deposit after their insurer pulled out days before closing, or the families forced to back out because their premiums doubled overnight. For years, Winter Park symbolized the dream of Florida luxury living. Now, it's the cautionary tale every broker in Orlando is whispering about. And the story doesn't end there, because Orlando's collapse is already echoing across America. What started in Orlando didn't stay there. By mid-2025, Texas and Arizona were seeing the same warning signs. Contracts falling apart, insurance premiums skyrocketing, and investors bailing out. In Houston, Dallas, and Austin, nearly 1 in 5 deals collapsed before closing. Phoenix saw investor purchases drop 36% in a single year. Builders who once couldn't build fast enough were suddenly sitting on empty subdivisions. Analysts said the same 3 forces were to blame everywhere: rising insurance costs, shrinking affordability, and investor fear. Climate risk and inflation had changed the rules. What happened in Orlando, an invisible collapse fueled by costs rather than supply, was starting to spread nationwide. And for homeowners across America, that realization was chilling. Because if a city once called crash-proof can crumble this fast, what does that say about every other boomtown running on the same logic? The Orlando collapse isn't just another real estate correction. It's a warning. It shows how quickly a hot market can unravel when insurance, interest rates, and investor confidence collide. In just 3 years, Orlando went from bidding wars and overnight lines to record-high cancellations and massive equity losses. Behind every statistic are real people, families losing deposits, retirees forced to rent again, and neighborhoods full of for sale signs. And while analysts debate whether this is temporary or systemic, one thing is certain: the old idea of Florida as a forever safe investment is gone. So maybe the real question isn't if Orlando will recover, it's which city will be next. What do you think? Are we looking at a local crash or the start of something much bigger? Let me know in the comments.